Welcome back to the Deep Dive. Today we are tackling a topic that tends to freeze the market solid. Commercial real estate investing when borrowing costs are soaring.
That's right.
When interest rates climb dramatically, the knee-jerk reaction for most investors is, well, it's predictable, right? Hit the brakes, pause, wait for stability, hoard cash. But what if that widespread caution is actually costing them the biggest strategic investment opportunity of the cycle?
That is precisely what the sources we reviewed suggest. For the disciplined investor, a high-rate environment isn't a crisis, it's a filter. It's the exact moment for a strategic repositioning.
A filter, I like that.
Our core mission in this deep dive is to extract the concrete methods that well-capitalized, prepared investors use to turn higher capital costs into a definitive long-term advantage. Success here, and this is crucial, isn't about accurately predicting when the Fed will lower rates.
No crystal balls.
No. It's about precise underwriting and disciplined execution right now.
Okay, let's unpack this. Because for many listeners, the idea that you should be aggressively shopping for, multi-million-dollar assets when the cost of debt is punitive feels completely counterintuitive.
It does.
Why is this the moment to be strategic rather than just sitting securely on the sidelines?
It all comes down to market behavior. High rates act as a financial shockwave. They immediately increase the hurdle rate for any project, making financing far more complicated and expensive.
Of course.
And this complexity, this expense, it causes a sharp, measurable slowdown across the entire CRE investment sector. The marginal players, the highly leveraged, the ill-disciplined buyers, they just vanish overnight.
And we have data that quantifies just how sharp that retreat is. The sources show us that in the first half of 2025, U.S. commercial real estate transaction volume dropped. Was it approximately 20% compared to the peak levels in 2024?
That's the number, 20%.
That means 1 out of every 5 potential buyers simply evaporated.
Correct. And that dramatic reduction in competition is what creates the opportunity. When the music stops and the buyer pool shrinks by that much, that creates 2 essential market shifts that benefit the prepared investor.
Okay. What's the first one?
First and most simply, you get downward pricing pressure. Sellers who need liquidity, or maybe their loans are maturing, they suddenly have fewer competing bidders. They become increasingly willing to accept lower prices just to ensure a deal closes.
So fewer buyers means sellers have to accept a haircut.
Exactly. The second, and perhaps more nuanced shift, is cap rate expansion.
Right, cap rates.
When we talk about cap rates, capitalization rates, we're basically talking about the annual net operating income of a property divided by its purchase price. It's a measure of the property's unleveraged yield.
And when interest rates go up, cap rates have to follow. But why is that a good thing for a buyer?
Because the price has to adjust downward to maintain that spread. Think about it. If the cost of borrowing capital, the risk-free rate, plus your spread goes up, investors demand a higher potential yield from the real estate itself.
Makes sense.
So if the income from the property stays the same, the only variable that can give is the price. The cap rate rises because the price of the property must fall relative to its income.
It's the market getting sober after a debt-fueled party.
That's a great way to put it. It brings property pricing back into line with the current economic reality.
So the high-rate environment scares away a huge chunk of the competition. Properties that were drawing multiple high-bid offers a year ago might now get far fewer, if any. And that translates directly into substantial negotiating leverage for serious, well-capitalized buyers. You get the chance to acquire prime assets at realistic valuations, often at significant discounts from their recent peaks.
It's the strategic advantage of counter-cyclical investing. The market is correcting those previously inflated valuations, and disciplined investors get to benefit from that correction. You secure a superior risk-adjusted return.
That distinction is so critical. But simply buying something because it's cheaper? That feels like a trap. Let's transition to finding and evaluating opportunities, because as the sources stress, not every discount signals a sound opportunity.
Absolutely. A fundamentals-first approach is key.
So how do you do that?
It is absolutely critical to differentiate. You have to discern whether the value decline is driven by capital markets, meaning the cost of money changed, or if the property is suffering from genuinely declining fundamentals.
And like what?
Things like local job losses, a major tenant vacancy, or, structural decay. You want assets that have simply become harder to finance, not assets that are fundamentally broken.
And based on the sources, priority should be given to asset classes that have shown resilience, even with economic headwinds. Which ones are we talking about?
We're largely talking about industrial properties.
Still benefiting from e-commerce and logistics.
Right. Then there's multifamily housing, given the persistent housing shortage, and specialized healthcare properties. These sectors tend to have more durable demand drivers that are less sensitive to short-term economic volatility than, say, Class A office space.
But even within those resilient sectors, you need to be targeted. Where should investors be hunting?
You should be looking at Class B assets or maybe selectively chosen Class C properties, particularly in established submarkets. The key is finding assets where you can add value.
And the sources mentioned some specific examples.
They did. They pointed to targeted secondary markets, citing some Indiana submarkets as an example where pricing has adjusted significantly, but the underlying job growth and demand are still stable.
That introduces an element of risk, though. If rates are high, shouldn't we only focus on the absolute safest Class A properties?
That's a fair question, but Class A assets often haven't corrected enough in price yet. The real returns often come from those Class B and C properties where the discount is a result of, say, deferred maintenance or inefficient management, things the new owner can actually fix.
So you're looking for specific value-add situations.
Exactly. Properties with short-term lease expirations, which lets you reset rents to market rates soon. Properties where rents are way under market, or places with transitional vacancy where some proactive hands-on management can immediately boost the income stream.
It sounds like this requires incredible market insight backed by data, not just a good gut feeling.
Precisely. You have to leverage modern analytics platforms for real-time visibility. This isn't just looking at quarterly reports. This is continuously tracking granular data.
Like what kind of data?
Granular rent growth trends, localized absorption rates, vacancy levels specific to a 3-block radius, comparable sales activity in real time. This information helps you assess whether the asset pricing truly reflects current fundamentals or if that discount is hiding a systemic problem.
So the underwriting process becomes far more rigorous than it was during the easy money days.
Absolutely non-negotiable. We call it stress testing. Advanced financial modeling is required to evaluate the investment across varying hostile assumptions.
Hostile assumptions.
What happens if interest rates rise another 50 basis points? For listeners, that's just half of 1%. But that small change can drastically alter your debt service costs. You have to model what happens if occupancy drops 5%, or if operating expenses spike because of taxes or insurance hikes.
You're essentially building in buffer zones against unforeseen turbulence.
That's the goal. This disciplined approach strengthens decision-making and ensures you have capital preservation strategies baked right into the plan from day one. And critically, you need diversification.
Right. Don't put all your eggs in one basket.
Don't get overly dependent on a single local economic driver or a shift in state tax law. It's just smart risk management.
Okay, here's where it gets really interesting, because we found the right asset, but now we hit the high-rate wall. How do you finance these deals when traditional bank lending is expensive, complicated, and often slow?
This is where the truly skilled investor separates themselves. You have to look outside the conventional sources.
So what's option number one?
The first, and often most overlooked strategy, is seller financing. This is where the property owner provides all or part of the loan themselves.
But why would a seller, especially one under pressure to sell, want to hold paper instead of getting a full cash payout?
Because it's often a better deal for them, too. First, they get certainty of closing and often a better interest rate than they would holding cash in a bond or a money market fund.
And there's a tax angle, isn't there?
A huge one. They can defer their capital gains by spreading the income over multiple years rather than taking a massive tax hit up front.
So flexibility for the buyer, tax benefits for the seller. It really is a win-win in a tight market.
Precisely. A second phenomenal option is seeking out assumable mortgages.
Okay, explain that.
If the seller has an existing loan that was secured during the low-rate environment, say a 4% fixed rate, the buyer can sometimes just take over that existing debt, provided the lender approves it.
That is a massive competitive advantage right now. You are essentially locking in a legacy cost of capital.
It fundamentally changes the economics of the deal. Your cash flow is materially better from day one.
What if those aren't on the table?
Then you look toward private lenders and debt funds. When traditional banks tighten up, these groups step into the void. They are typically higher cost, yes, but they offer crucial advantages.
Like speed.
fast execution, less red tape, and customized structures that support the very value-add strategies we're targeting. They'll take on complexity that a standard bank would just refuse.
And finally, the power of pooling resources through, joint ventures.
Joint ventures, or JVs, and syndications. This is vital, especially for larger opportunities. You pool capital and expertise, share the risk, and access deals that might be too big for a single investor.
So you reduce your individual exposure.
Exactly. And you can deploy more equity to reduce your reliance on that expensive debt in the first place.
Beyond the financing itself, our sources highlight leveraging tax strategy to enhance returns. In this environment, every basis point saved is crucial.
Absolutely. We start with the 1031 exchange. This is the cornerstone for active investors. It lets you defer capital gains tax when selling a property, provided you reinvest the proceeds into a like-kind property within strict timeframes.
So you can redeploy 100% of your capital without a tax drag. That's huge.
Incredibly powerful. And then there's accelerated depreciation.
How does that work?
That relies on a cost segregation study. It's basically an engineering study that identifies parts of a building that can be depreciated over shorter time frames, 5, 7, or 15 years, instead of the standard 39 for commercial property.
So you're front-loading your depreciation.
Right. You increase your paper losses, which offsets current income, and improves your cash flow dramatically in the early, often tight years of the investment.
And we can't overlook local incentives. Things like local tax credits and energy rebates, especially for making energy-efficient improvements.
Which not only lower your operating costs long-term, but give you immediate financial relief that helps an expensive deal pencil out better.
We've covered finding the assets and financing them creatively. Now we have to address execution, because as we said earlier, high rates compress your returns, so they magnify mistakes exponentially.
Robust due diligence is absolutely essential. You cannot cut corners. Investors need to focus intensely on structural deficiencies, potential environmental concerns, title issues.
But what's the single most crucial element in this market?
Tenant credit quality, no question. If your tenant is highly leveraged or operating on thin margins, an economic downturn magnified by high rates means your income stream could vanish and your whole investment collapses.
And the analysis has to go beyond the building itself to the macro market level.
Definitely. Deep analysis of local vacancy trends, primary employment drivers, the future supply pipeline of competing properties. You're evaluating the health of the entire neighborhood, not just the asset.
Right. And remember that shift in leverage we discussed. Since buyer competition is down,
the leverage has decisively shifted to the prepared investor. Negotiation is not just about the sticker price anymore.
That's a great point. What are prepared investors securing beyond just a lower price?
Oh, they're getting concessions that were impossible during the peak frenzy. Things like extended due diligence periods, which gives you more time to find and fix potential flaws.
What else?
Demanding seller credits for necessary capital improvements you find during inspection. Or securing flexible closing timelines, structuring agreements that balance risk while preserving flexibility. It materially improves the deal economics.
Finally, let's look at the long-term view. Risk management and maximizing returns over time. What strategies must investors use to preserve capital and ensure resilience?
Liquidity is paramount. You have to maintain adequate cash reserves, not just for operations, but for unexpected expenses or market disruptions, so you're not forced into a fire sale.
And you mentioned stress testing earlier.
You need to continuously evaluate risk through regular stress testing and scenario planning. You have to know exactly how a sudden swing in rates or occupancy or operating costs impacts your debt service coverage ratio.
And that continuous testing needs to inform your biggest plan, the exit strategy.
Absolutely. You must create multiple viable exit options. Be prepared for different scenarios, selling, refinancing, recapitalizing, so you can respond quickly and adaptably to shifting market conditions. You can't be locked into one single hopeful plan.
And long-term returns. They rely on active, hands-on asset management, not just waiting for the market to appreciate.
That's the real work. You have to focus relentlessly on improving operational efficiency, strengthening tenant retention through superior service, and incorporating value-add initiatives like those energy-efficient improvements. That's how you unlock value that far surpasses the initial discount you negotiated.
It seems like this whole environment really tests an investor's discipline more than anything else.
Their discipline and their psychology. When uncertainty rises, fear pushes the majority of investors to hesitate and retreat. But conversely, the thrill of a correction can lead to overconfidence and rushed poorly structured decisions, among others.
And both are equally costly.
They are. Successful investors rely on data-driven analysis, they adhere to their conservative long-term strategy, and they filter out the short-term market headlines and volatility. This is a behavioral challenge as much as a financial one. You have to overcome that fear of acting when everyone else is paralyzed.
So what does this all mean? The core takeaway is clear. High rates aren't a catastrophe. They're a necessary filter that dramatically thins the competition. This environment rewards investors who stick strictly to fundamental underwriting, who are creative with financing, and who execute with discipline. This is the chance to acquire high-quality assets at realistic, superior valuations that others just overlook because they're paralyzed by the fear of the immediate cost of capital.
It's the time to act strategically, not retreat defensively.
The only way to capitalize on reduced competition is to act when others are frozen. So here's a final provocative thought for you to chew on. If the current market conditions force you to be more disciplined, significantly more data-driven, and more creatively focused on debt solutions than you ever were before, are these high-rate cycles ultimately making you a better, more resilient investor in the long run? Something to mull over until our next deep dive.
Get in touch with Allies Commercial Realty at info@alliescommercialrealty.com to find your ally in commercial real estate.